Today we'll touch on LNG and LPG. We will touch upon gas prices and gas demand, rates, chartering strategy, and asset values. So we have quite a busy day in front of us. Our panelists, we have Mr. Ted Young, who's the CFO of Dorian LPG. Dorian is listed in the US and has a large fleet in excess of 22 large LPG carriers. We have Mr. Christos Economou, is founder and CEO of TMS Cardiff Gas. It was founded in 2011 and currently manages Cardiff's LNG and LPG fleet. It owns 5 LNG carriers and have 4 VLGCs on order. We have Mr. Tony Lauritzen, who's the CEO of Dynagas LNG Partners, is also listed in the US. Has 6 LNG carriers with more than 10 years average remaining charter backlog. Plus, there's a number of LNG carriers in the parent company. And finally, we have Mr. Stavros Hatzigrigoris, who's the managing director of Maran Gas Maritime, which is a private company, and holds a fleet of 18 LNG carriers and now 12 in order. So before we put the word over to our panelists, I would like to ask the audience for help. If we look at the LNG and LPG spot market today, we see rates, both realized rates, averaging roughly $25,000 a day. So I would like for the audience to help the panelists out with understanding which of these markets will recover the first. So we're going to do a bit of a hands up, a bit of exercise for the audience. So first I'm going to ask for LNG carriers, and those that believe that LNG carriers will recover first, put up their hands. Then I'm going to ask for LPG carriers. And I am the judge by counting. So first, those in the audience that believe that LNG carriers will recover before LPG carriers, hands up. I count less than 10 hands, that's very positive. So for VLGCs, those that believe that VLGCs will recover before LNG carriers. That's only one hand. You're not a very good crowd, are you? So I think we'll move over to the panelists instead. Mr. Economou, the audience was not very much at help here, but you're an owner and manager of both LNG carriers and LPG vessels. Being private, you could also probably be a bit more vocal in your beliefs on which of these segments will recover first.
Thank you, Owen, for the introduction. I guess I have to be careful in this room on what I say, but I will speak as honestly as I can. So first of all, we would like the audience to be a little bit more engaging. That would be great. It would be more interactive. So I think from my standpoint, just to be clear, I operate LNG carriers in the spot market, and the VLGCs are on term business. So when I speak on VLGCs, it's more around what I read and my market relationships rather than the fact that I have ships in the water. So, I mean, we've all seen on the VLGC side how the market kind of came down. A lot of it, obviously, because of the order book and the lack of the arbitrage trade. I think on the VLGC side, a lot of the shipping is built on the long-haul route from the States, so States to Asia, and that comes out a little bit oversupplied now, especially once the ARB closes. So I would say that it's very ARB-driven. It's hard to grasp what exactly the Saudis will do next year or two on that, and how the pricing of the product will go out of the States, given all the new plants that are coming out from the States. So I would say it's a harder market to grasp. You need to get rid of all the new building, you need to have all the new buildings that are delivered this year hit the water, and then once that takes place, you'll have a more interactive market where you can have that inelasticity of demand and actually have a better market than what it is today. On the LNG side, I think we've kind of been through that part of the cycle, probably in my mind, probably I would say last year. It's continuing today, but what you see is real volume growth without actually having the supply side the supply on the volume side without having the supply side on the shipping side coming online, at least no speculative orders. So I think once that has stopped, then we'll let demand do the talking. I mean, I don't know if I'm talking my book or not, but it's I would say between the two, I'm more positive on the LNG side right now, just because it's been 2 years into a down cycle. And I think that there's big volume growth, 30% over the next 2 years, without necessarily having the same spot ship. So that would be my answer, Roland.
Thank you. So definitely LNG carriers then. And Mr. Lauritzen, your LNG fleet of 6 LNG carriers have 100% utilization this year, but you have 1 vessel coming off next year. How should we think about the technological development? There's slightly bigger vessels, slightly better engine technology. How should we think about yesterday's flavor, the slightly older, the slightly thirstier LNG carriers coming off for renewal?
Thank you. That's a very good question. I would be a bit more specific, and I would say that this year we have 100% fleet cover, and next year we have the 88% fleet cover. But I think that utilization will be close to 100%. When we think about technology and how it goes forward, I think it's important to keep in mind that it's not only one ship that is the standard ship. The market needs many different types of vessel sizes. If all vessels were 174,000 the cubic meters, we wouldn't be able to serve the market as it should be served. So when we look at our cover going forward, and I mean, let's say that we go 12 months back in time, it looked majorly very different from what it is now. In the last 12 months, we've been able to secure very good charters for example, 218, the commencement. So I think that we cannot just look at the latest technology and see that vessel will serve the end market in its entirety. When we talk about technology, I think size is as different as the propulsion. The average cargo size today is 143,000 the cubic meters. So I would say that if you have vessels that are significantly below that size, then you potentially have a problem because you can't really lift the desired volumes going forward. If you, for example, have a Q-Flex type vessel today, maybe your vessel is too large, so you have a lot of dead freight. So also, I think it's important to look at where are the volumes coming from going forward, and where will they go. So we see a lot of volumes coming from Australia and the US. So it's not unreasonable to believe that, for example, maybe more than expected volumes will go to Europe, and obviously the Australian volumes should go in its majority to the Far East. So then you suddenly have a dynamic where you would have intra-basin trades instead of going, for example, from the Atlantic to the Pacific, which doesn't call for that large vessels. So let's say our current fleet is typically in the region between 150 and 162,000 the cubic meters, which I think is a very flexible vessel, is a very tradable vessel. It can call any terminal. In addition, the vast majority of our fleet is ice-classed and winterized. That gives another ability, and we have secured many charters on the basis of that. Thank you.
Thank you very much. Over to you, Mr. Hatzigrigoris. Your company rely on gas majors largely for long-term charters. How do you think about dependence on a few large charters? And how do you think of the changes in the LNG market? We will see more short-term trading, more short-term contracts. Does this change how you think about your charter policy?
Thank you for the question. I think the company philosophy has been to fix, let's say, medium to long term, and I don't think that this will change in the future. The main reason for this is that we follow an expansion policy, but it's a cautious one. We will not order an excessive number of vessels unless we have in the pipeline business for them. I don't know what you mean by changes in the chartering market.
What I mean by that is we see the market moving from simply being a floating pipeline, more or less, 10 years ago, to being more and more short-term volumes, reloads between basins, etc. Does this change how one should think about the charter market?
I think it will change the charter market, but we are not going to get involved in this kind of trading. We leave it to our charterers to do that. And I believe this is what the charterers are doing today. As you may know, BG have been sold to Shell, and we are waiting to see what the new policy of Shell will be. Go for projects, go for trains, go for long-term projects, or continue the successful policy that BG had in the past. I tend to think that there will be more and more trading done by the major charterers.
Thank you. Over to you, Mr. Young. Tony wants to say something.
I think we have some additional things to say here. I think that the market in general is seeing a lot of change on the trading side, and we see that we see that in the way that the vessels are traded. Who are the counterparties? The counterparties are changing quarter by quarter. We see a lot more new spot cargoes on the market. We see, there's a tremendous amount of supply coming, but it's obviously that a lot of that supply is going to emerging markets or new markets. And a lot of these new markets, they don't necessarily have the credit to support to buy these cargoes long term. So it means that innovation in the way that vessels are traded is important. That's why we formed the Cool Pool together with the Golar and the Gaslog, so that we are able to serve these customers that are specifically looking and targeting new ways of chartering vessels.
Thank you. Very enlightening. Mr. Young, you're a large owner in the LPG space, with probably the youngest fleet now. You also have a large buyback scheme in place. My question is really, what's the way forward for Dorian? Will you buy back your own shares? Will you aim to start paying out dividends? Or are you rather looking to grow through either new buildings or buying one of the smaller competitors?
Yes.
Very enlightening.
Fair question. I think, obviously, we're always looking at our capital allocation strategy and reviewing where we find the best returns. Right now, as we've said numerous times in the public, we see value in our stock given the imputed value of the capital markets applied to our VLGCs versus where we see the intrinsic value. If acquisition opportunities present themselves, we'll certainly give that due consideration. Dividends are something that's are always on the table. Our competitors have been quite active and regular dividend payers. I think given where day rates are at this particular moment, we think it's probably judicious to focus on buybacks, just given what that's done to stock prices. But any and all those options are on the table.
Thank you. So moving on to the oil price. Mr. Economou, it seems the oil price has at least been a strong explanatory factor in the equity markets for shipping equities over the last year, and in particular in the gas segments, especially on the way down. Why do you think this has happened? Do you have any thoughts on why oil and shipping has been so closely related?
I mean, this is by talking to, I guess, capital partners in the States, whether it's hedge funds, private equity shops, or individuals that have positions in the markets. I think that the last, since the oil crash started taking place, you had a lot of people pull out from anything energy related, and people have been burnt in the past. So I would say that shipping was the least of the focus of a lot of these larger institutions. Also, shipping, don't forget, is a little bit of an e-liquid class, meaning that it's not even considered mid-cap because of the size of the companies. So I would say that weighs on valuations. So once you have volatility in the market, you're probably looking more to liquid names. So if energy is I would say a short, then shipping is even more short. So I would say that would be my correlation to the market. Now, again, depending on how sophisticated your average investor is with regards to the public companies, my view is that oil, obviously, and the oil services index kind of correlates pretty closely, and I would say shipping probably lags that. But in the end, they are significantly different in terms of their actual market fundamentals. So I would say, if anything, there's probably an arbitrage to be had there. But it is what it is. So the function of the market is basically the liquidity and what the major hedge funds think. So I would say that's my view. Of course, now we had a rebound on oil price over the last since the beginning of the year. So we haven't really exactly seen the same on shipping. So I would say probably the worst of both worlds. But again, it's revaluing cyclical industries, which right now is a difficult punt for anyone. So I would say that's my gut feeling.
Thank you. And pricing of LNG has also traditionally been linked to oil. Mr. Lauritzen, with new volumes coming into the market, with new pricing models for LNG coming into the market, not only buying oil price linked, but buying US domestic gas price linked. How should we think about, first and foremost, breaking this oil correlation? What's that going to do to shipping? Is it going to happen? When do you think it's going to happen? What's your thoughts about this?
Thank you. That's a very difficult question. So, I think then first we have to look at, why was gas linked to oil in the first place? And I guess that's in particular in the Far East when gas became a replacement fuel for fuel oil. It was natural to have an oil-linked, pricing. Also, since there is a possible fuel switch there, it protects the buyer from, let's say, paying too much on the gas prices versus oil. And I guess that in the past also financiers felt comfortable financing gas assets on, let's say, oil-linked return on investment that has traditionally done very well. So I guess these were a lot of the parameters why it used to be that way. In particular for the Far Eastern market, I think that we'll see a continuation of it. I think that over time, maybe it will shift towards a gas on gas instead of a gas on oil market, but that can take some time. I think that as also the gas industry is growing, and the total gas industry now in terms of energy is almost as large as the oil industry. So there's no real reason why we should use oil as an index factor. When we're starting to see volumes coming out of the United States, where often these projects they don't necessarily own the gas fields, they buy feed gas linked to Henry Hub. Well, then it's natural to ask for a Henry Hub linked price to be adequately protected. So that I think we'll definitely see for US volumes being the dominant requirement of the seller. Also, Europe is becoming a larger market, and we think that it will become an increasingly larger market going forward. And there is absolutely no need in Europe to have a crude oil-linked pricing. So I think that the answer to your question is that yes, we will see a D-link, but gradually over time.
Thank you. Over to you, Mr. Hatzigrigoris. Based on this question, based on the changing pricing and the changing dynamics in the market, how will this affect LNG shipping? Will we see new trade routes? Will we see more in-between trading? Will we see any sort of changes based on the market going from being stable pipeline market to being several types of pricings, more trading, etc.?
I think definitely we will see more trading, and the reason for this, apart from the pricing that was just mentioned, is the fact that we have seen huge investment in new LNG projects. I don't think that, for example, the Australians can keep non-operating projects that have costed 70, 80 billion dollars. So I think we will see more gas. It is natural that we will also see more gas trading, because the major LNG buyers for the past, let's say, 30, 40 years have been the Japanese, and the Japanese are now changing their purchasing model. This will cause more trading.
Thank you. Mr. Young, LPG has also been largely, did you want to comment on that? Oh. LPG has also been sold to Asia largely linked to oil, while the recent arbitrage, which has led to the boom in LPG, at least our thesis, has been that you're buying cheap waste gas, in a sense, from the US. How has this arbitrage affected your profitability, and do you think that there will be changes to this market going forward?
I don't think there's going to be significant changes. LPG has always been a byproduct or a waste product, and that hasn't changed. It's stripped out of oil and gas. I think one of the big drivers of the cheapness of US LPG had been the cheapness of obviously US LNG, natural gas. And at the same time, oil was relatively dear, and 25% of our world market goes into petrochemicals. And so there's a fairly healthy arbitrage between naphtha as a petrochemical feedstock and LPG. So we were on the right side of that trade for quite a long time. We're sort of getting closer to being back on the right side of that trade at this point as oil prices have rallied some. So, fundamentally, we don't see major changes. I think the only change that we do see, which has surprised us quite pleasantly to the upside, has been the growth in our core business, which is residential heating and cooking. Historically, that had been sort of the GDP stroke population growth type business, but we've now seen, thanks partially to the lobbying efforts of the World LPG Association, but also I think a broad recognition from countries around the world that it's a much better gas to burn than kerosene and biomass. So we've actually seen pretty substantial growth in India and China, which both have very well-documented air problems. So, I think that's where we see potential long-term changes is more consumption for domestic and commercial use, auto gas. But I think we expect to continue to see, petrochemical demand being fairly steady. And again, to the extent that LPG is more favorably priced than naphtha, then we expect to see, I think, market share gains there.
Mr. Hatzigrigoris, you mentioned that there's a lot of new LNG coming to the market, and there certainly is. LNG has historically, it seems, over the last years at least, been constrained by the volumes that you could put into the market. So if you could produce the LNG, you could actually sell it. And now we see there's 40% increase over the next 3 years in export capacity globally. Where will all this LNG go? Who's going to be the buyers of this?
I will not add anything to what I said before. I don't believe that projects that have costed 78 billion US will stay idle. So I think more LNG will be produced. This LNG will have to be transported. Maybe it will have to go from place to place. Maybe the prices will drop. But I think the supply will be there.
Yeah, and let me jump in there. I mean, obviously, a lot of the volumes are controlled by the largest customers in the trade. My view, no, their view is a lot of that is going to end up in Europe because of the marginal increase that they can have in terms of a lot of the marginal increase that they can take on the gas side. At the same time, we see China being a big demand center. I guess probably growing 5% year on year. And I think they're adding around 50 million tons of regas capacity to the market. So there's definitely a political shift there in terms of going clean. I mean, anybody who's been to Beijing or elsewhere is knows what exactly goes on there. The smog, et cetera, et cetera. So there's a shift there. Now, how fast that happens is difficult to quantify because it's led by government efforts basically. So nobody really knows how that works out. But I would say that those for me are the two largest demand centers. So you'll probably have gas from the States on the spot side end up going to Europe and probably similar and hopefully similar anyways to Australia. And then obviously the biggest incremental buyer has been the Middle East, the Middle Eastern markets over the last years. So it's once people get hooked on cheap gas, then it kind of flows in the system. So I think that's what we're expecting to happen. And a lot of it has to do with how the SPAs are written. So in Australia, basically, you have to produce. In the States, it's kind of take or pay. So in the end, you can actually, you don't need to actually produce the actual cargo if you don't want to. So I would say that as Stavros said correctly, that the volumes will flow. So that's net positive for shipping. Now, how fast that's going to impact the market depends on how fast the projects are going to be able to ramp up. But that's my view on the market, and it's interesting times for LNG.
Yeah, a little bit further to what you said and what we said earlier is that we also believe that there are several new countries that are more niche markets, smaller countries, not necessarily with the right credit line to to commit to long-term gas, but that is lining up for importing shorter-term gas. And we've analyzed it a little bit, and we see a list of maybe 15 new countries or so that we think are very likely candidates for taking additional volumes. Also, as Mr. Stavros said earlier, the big projects that are spending billions of dollars constructing new terminals. The reality is that they've sold the majority of that gas already.
And the obvious question, which I'm going to address a bit widely, and please feel free to answer it. What's all this new shipping need going to do with rates? Any takers?
I'll leave that to Tony.
No, more. I think it's easy. More production, less clear buyers means a lot more need for vessels. So that would drive rates up, clearly.
The question is when, though?
Oh, when? Sorry. Well, we believe that we are in in a state now where we've seen the last couple of maybe last 3 years or so being very static in terms of world production. World production has been around 240 million tons per annum. It was supposed to have incremental volumes earlier, but then we saw some. We saw some interruptions, for example, in Egypt. Egypt became an import market instead of normally being a large, export market. Then we've seen some technical issues in, for example, Angola LNG that took a long time until looks like they're finally will be up producing. So that has, let's say, pushed forward the anticipated, increasing rates. But I do think that we are in a year now where we are seeing incremental LNG being produced. We are seeing the ramping up from new Australian projects. I do think that we'll see the projects that had technical issues, they will be up and producing later this year. So our projections is that the end of the year will look better than what it is now, and going into next year, we think it will gradually be increasing quite well, and we think actually 2018 will be a really good year. So that's kind of from the production side. When we look at the shipping available, we have to note that although the order book is quite big, the number of available vessels in that order book is very small. Around 11% of the order book is actually open for long-term chartering. So although we have right now, we have let's say short-term or medium-term availability, there is virtually no availability in the long term, and that's a critical factor. So at some point, we'll see, that there is more production than what there is available vessels. Also, when we look at the current fleet today, around 30% or so of the existing fleet is below the average cargo size. It's about 18 years old, and it's just not a great specification for today's charterers that want to program for term. So I think that we'll see by the end of the year and certainly into 2017, I think we'll see a good improvement.
On a bit of a side note here, we're talking about size of fleet. Mr. Young, Dorian is obviously quite a large operator in the VLGC space. How large a fleet do you actually need to be large enough?
I'd say if we're not there exactly, we're pretty darn close. I think we're able at this size to do everything our customers want us to do. Particularly, we've expanded our reach by our pooling arrangement with Mitsui's Phoenix Tankers group, as well as we've just taken in 8 vessels from Oriental Energy. So our reach is actually quite broad. So from where we are, from a fleet size perspective, we feel pretty good. I also think, picking up on some of Tony's comments, they're remarkably similar, if not identical, to the dynamics we see in the VLGC market in terms of looking at both the order book and the size of the fleet. We have a similar dynamic going on, and that is the current generation of vessels is both more fuel efficient and slightly larger in terms of cubic carrying capacity than the prior generations. So not only having the vessels, but also having the right spec vessel is increasingly important to our customers. All of our new ships are Eco VLGCs, so they all have electronic engines and friction-reducing paint and all those good things. And so we're seeing nice improvements in fuel consumption. Obviously, that means that we're generating, on average, a better TCE than older vessels. And I think all those sorts of things are important to customers. And again, I think it allows us to be responsive. And I also think it bodes fairly well for the younger part in general of the global VLGC fleet.
This is a very interesting theme, and it's about technology risk. What's the vessel that the market really wants? If you look at the fleet today, 60% of the current on-water LNG carriers have steam turbines, which on our numbers, there are of course degrees of this, but which on our numbers, a modern turbine vessel could be $20,000 to $40,000 less efficient on a TC basis compared to new build today. And we also saw Golar LNG, one of your peers, putting 2 fairly modern vessels into layup, as they announced that last week. So Mr. Hatzigrigoris, how do you think about the technology? What is the optimal vessel today? What's going to happen with the older vessels? Would you share some thoughts on that?
I think some of the older vessels, they will have to be scrapped, not only because of size, as Tony mentioned before, but also because their propulsion plant is not efficient. It's nothing close to $20,000 to $40,000 per day, as you said today, because the oil market the oil price is down. But certainly we will see some of the older steam vessels to do something else, maybe converted to FSRU, maybe scrapped, maybe. We have seen a very fast development in LNG technology during the past few years. We went from steam to DFDE. Some people are talking about direct drive dual fuel four-stroke engines. We have the MEGI concept, we have the XDF, and we have the gas turbine coming back for project vessels, not for vessels that will be trading in the spot market. The optimum size, if you are asking me, just because of the US export, seems to be the 175 size. I'm not saying that the smaller vessels, and especially the 160s, 162s, will not be tradable. But it seems that if the market today is, let's say, US export driven, then the optimum size should be the 175.
So just a quick follow-up to that.
Let me just jump in there one sec, if you can.
Go for it.
I mean, I think, you have investors, and I agree with Stavros in most of his points, but I think you have investors basically focusing on what the optimum size is and this, that, the other. If you have the spot market, which is pretty much, I would say, 50 ships, and like 90, apart from the steam vessels, you have every other ship in the spot market being a 160. That's your average cargo size. It doesn't matter, if people prefer the 174s, that's going to be for your long-term business, because in the end, it's a function of what's available in the market. And on the term business, again, like in the States, most of the SPAs are contracted on a 160 basis, and then obviously you have a top up off that. So if you're in a position where you're actually not making money, usually you want to get the smallest quantity. Or not take it at all. So again, I mean, of course you have more flexibility with a larger size, but in the end it's a function of what your actual availability in the market is. And don't forget, I mean, last bull market that we had, because everybody's discounting the steamships and the old ships, doesn't matter. In the end, they're in the market. Unless they leave the market, they're still part of the market. So last cycle we had in 2011, you had basically steam vessels. We fixed 120,000 per day for 4 years. You had people fix 138s at 130,000 for 3 years. So in the end, once the market gets tight, it doesn't matter what kind of vessel you have, because volumes have to move. It's just in a low market, people would prefer the newer, better tonnage, because if something goes wrong, it's that guy's position in his company, because there wasn't available TFD ship or mega ship. Sorry about that. Go ahead.
Sorry, we're running a bit out of time. I just want to ask one quick question, and I need a really quick answer from each and every one of you. And that's, Mr. Hatzigrigoris mentioned that some vessels need to be scrapped. So just one sentence each. How old LNG carriers can you operate before they need to be scrapped?
Maybe vessels older than 15 years old will have to be scrapped.
Mr. Economou?
I think that you'll have, as Tony said, the smaller sizes. So you'll have, basically, in my view, below 145s are the likely candidates to go first. So, I wouldn't put an age restriction, I'll put a size restriction.
Thank you.
I totally agree with that. Size is more important. So I go below 140.
Would you like to comment on that, Ted?
Just remember that the first 145 was delivered in 2005.
And these are vessels built to last 35 years. That's why this is shocking, but it probably has to happen. Thank you very much, our panelists, and thank you very much, audience, for coming today.